All right, let's get right into it. Today, we're digging into one of the biggest questions every single investor has to ask themselves. Are you in this for steady cash now, or are you trying to catch lightning in a bottle for huge growth later on? We're going to break down dividend investing versus growth investing and help you figure out which path really makes sense for you.
I mean, this is really the whole thing, isn't it? Do you want your portfolio to be like a trusty vending machine? You put money in and it reliably spits out cash for you on a regular basis? Or are you looking for a rocket ship, something that could take you to the moon, but you gotta be ready for a seriously bumpy ride to get there?
So that choice really sends us down one of two very different roads. You've got the income path. Think of a patient farmer just cultivating their crops, getting a predictable harvest. And then you have the growth path. Let's start with the farmer. Yeah, this is the path for anyone who really values consistency. It's all about tending to an investment garden that you know will produce a harvest, season after season. The goal here is a steady, reliable stream of income. Okay, so what is dividend investing exactly? Well, it's when you buy shares in big, established, kind of boring companies. You know the ones, utility companies, major banks, those blue chip brands you see everywhere. These guys make a profit, and they decide to share a slice of that pie directly with you, the shareholder. That little slice is the dividend, and it shows up as cold, hard cash in your brokerage account. So what's the upside? Well, the most obvious one is that predictable income, right? But honestly, don't sleep on the psychological comfort. Getting paid a little something, even when the market is going sideways or even down, that's a huge mental win. And of course, if you take those dividends and reinvest them to buy more shares, you kickstart the incredible power of compounding. That's how real wealth is built over time.
But of course, there are always trade-offs. These stable companies, they usually don't grow as fast. And those dividend payments you get, yeah, the tax man wants a piece of that. Plus, there's always the risk a company hits hard times and has to cut its dividend. And that last point is super important. If you see a company with a crazy high dividend yield, be careful. That can be a huge red flag that the stock price has tanked because the market thinks the company's in serious trouble.
This quote just nails the mindset of a dividend investor, doesn't it? It's for the person who says, look, just give me that regular cash flow. I want a smoother ride and a lot less stress. Okay, let's flip the map over and look at the other path. This is the fast lane. This is for the investor who is laser focused on building some serious wealth by betting on the companies that are going to change the world tomorrow. With growth investing, the game is totally different. Here, you're buying into companies that take every last cent of profit and plow it right back into the business. They're trying to grow, expand, innovate, fast. Think about disruptive tech companies or cutting-edge biotech firms. The goal isn't a quarterly check. The goal is for the stock price itself to go to the moon over time. Now, the main attraction here is pretty obvious, the potential for absolutely massive long-term returns. But a killer feature is how tax efficient it is. Since you're not getting those regular cash payouts, you don't pay a dime in taxes until the day you decide to sell. That could be decades from now. It's a really powerful way to let your money grow without the government taking a cut every year. But you gotta have a strong stomach for this path. Man, are these stocks volatile. We're talking huge swings in price, both up and down. There's no cash flow coming in to make you feel better when the market's crashing. And it's so easy for these stocks to get caught up in hype, with prices getting totally disconnected from reality. This strategy absolutely demands patience and the discipline to not hit the panic button and sell at the worst possible time. This is the growth investor's mantra, right here. It's all about having your eyes on a prize that's way out on the horizon and having the guts to ride out all the crazy storms the market throws at you along the way. Okay, so we've walked down both paths, we've seen the scenery, now it's time to put them right next to each other for a direct head-to-head comparison. Let's see how they really stack up. So here we go, the showdown. Let's break down where these two strategies win and where they lose. This table just lays it all out, nice and clear. You need cash in your pocket now? Dividend investing is your answer, plain and simple. You're hunting for the biggest possible gains over the long haul? That's got to be growth. But look at the trade-offs. The lower volatility and lower emotional stress of dividend stocks versus the higher stress that comes with growth stocks. The key thing to see here is that one is not better than the other. They are just different tools for different jobs. All right, now we get to the most important part of this whole thing, turning all this information into a decision for you. To figure out your path, you have to get honest and answer a few really critical questions about yourself. First up, how much time do you actually have? Seriously, Are you investing for retirement in 30 years, or are you saving for a down payment in 5? The longer your timeline, the more time you have to recover from those big swings in growth stocks, and the more you can benefit from their potential.
Number 2, and be real with yourself here. Do you need your portfolio to generate cash to live on? Are you trying to supplement your salary, or are you already retired? If you need that regular paycheck from your investments, well, the dividend path starts to look a whole lot more attractive.
And finally, how does your gut feel when your account balance suddenly drops 20%? Does that thought make your stomach clench and make you want to sell everything and hide under a bed? If so, the calmer waters of dividend stocks might be a much better fit. But if you see a drop like that and think, ooh, buying opportunity, then you might just be built for growth. So based on those answers, here's a super simple starting point. If you're young, with decades ahead of you, it probably makes sense to lean heavily into growth. As you get closer to retirement and actually needing that money, shifting more toward dividend stocks for that stability and income is a classic move. And for a whole lot of people, the right answer is somewhere right in the middle, a blend of both.
And that idea brings us to a really powerful conclusion. You don't have to pick a side. You don't have to be a purist. In fact, a lot of the smartest investors out there don't choose one path. They create a hybrid strategy. And you can mix and match these in some really clever ways. The easiest way is to just own both. Buy some growth funds and some dividend funds. You can also do that life cycle thing we just talked about. Start heavy on growth and then gradually shift to dividends as you get older. Or you can get really strategic with taxes and hold your high-flying growth stocks in your tax-advantaged retirement accounts to let them grow completely untouched by taxes for as long as possible. The point is, you really can get the best of both worlds. So, at the end of the day, there's no single right answer here. We've laid out the two main roads you can take, the steady cultivator and the future visionary. The real question isn't which path is better. The question is which path or what combination of paths is going to get you where you want to go.